There are going to be some years, 2008, we're going to be 30-40% off, and there are going to be other years like, 2024, where we have decent returns. So we can't afford to be complacent in retirement and not worry about our money.
Welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 10 straight years and running concurrent. We always appreciate being joined by the founder and CEO of GulfCoast Financial Services, John Kuykendall, here on the program to talk a little bit about your money and the planning strategies that are available so that we can further our progress toward those important financial goals. And John, unfortunately, there's a lot of mixed information. There's a lot of misinformation. There's a lot of myths and misconceptions out there in the financial world that people depend on when they're kind of forecasting out their financial future and planning for it. So wanted to talk about a few of those and identify them on today's program and basically kind of confirm that we need to carefully examine the assumptions that our financial future is based on.
Yeah, Peter, there are a lot of things out there that people listen to. Sometimes their neighbor who's always making more money than they are, which I discourage, because everybody wants to be a winner. But there are 7 financial myths that we talked about earlier that I would, certainly like to talk about today, at least some of them. And, the first one is the market always goes up. I mean, we've been in kind of a Disney world here lately, where the market has done remarkably well. And as we've talked on some programs, during an election year, the market shows some volatility, but it definitely is always up. Historically. And so, but, the market doesn't always go up. There was a time back in 2000 to 2012 where the market started out with a number and ended up with the same number. So during that 12-year period or 10-year period, which is a lost decade, the market didn't do anything. But through dividends and reinvestment, and dollar cost averaging, most people were really up in those markets and didn't really realize that the market hadn't gone up. So, that's one of the things that people really always come and talk about. I want to be in the market.
So in that period, John, through making contributions, through reinvesting, even though the market was essentially sideways, it lost about half its value, gained it back, lost half its value, gained it back again twice during that lost decade, which was really more like 12 years. But even though the market's value, the number on the stock market index, didn't move forward over that period, a lot of people who were still working actually were able to make forward progress during that period. Explain that, and then explain the difference, if you would, with how that would work in retirement when we're no longer taking advantage of contributions and additions.
Well, through dollar cost averaging into the market. So we're buying at different levels. The market goes up, we buy some, the market goes down, we buy some because we're doing periodic payments into our 401ks or into mutual funds. Certainly we're buying at different levels. So it gives us a way to buy stocks at different prices and average out our losses and our gains. And then through the dividend reinvestment, and just compounding that reinvestment, Peter, a lot of mutual funds during that 12-year period were able to show double-digit returns. I know American funds, looking back on theirs, they had some tremendous returns where the market didn't go up. But the main thing was we stayed in the market. Now, the difference for retirees is I don't have 12 years. I'm drawing my money out all the time to live on because I'm paying myself. And if the market goes down and loses 20, 30%, and I'm drawing 4 or 5%, I've lost 34%. I don't have time to make it back up. So it's really important that in those years where we're in accumulation phase, We're putting money into the market. We're doing our normal weekly or monthly contributions to our 401ks and to our Roths and to our investments, that we stay in the market and stay invested and not try to time the market. But then we've got to be more proactive during retirement, Peter.
It's like the old definition of insanity is doing the same thing over and over and expecting different results. But this is kind of the opposite of that. It's that the behavior is completely opposite. We are doing the exact opposite thing and expecting the same results, right?
Yeah.
It's almost equally as insane there to continue the same mentality, the same investment approach when the dollars have change direction 180. It's like going to the pool and holding my head above water. I'm breathing no problem, but I should not expect the same result underwater. And if I'm driving forward, looking forward, John, it's probably not a problem. But if I'm driving in reverse, I should not continue looking forward, right? I should look at the direction that things are coming at me in. And people here are keeping the same investment approach that would work kind of regardless of market conditions, as long as we're making those contributions. But when we begin making withdrawals, it really changes the impact on our portfolio value and can actually be quite devastating to the financial outlook, which is why we need to carefully examine this myth number one, that the market always goes up.
That's right, Peter. And it doesn't always go up. And as I said, when we're doing our distribution phase, we're living off of our retirement. We can't afford to have huge losses and not adjust our portfolio because we're not dollar cost averaging into that market, and we're not able to leave the dividends there because we're living on them. And so that goes back to what we call is, the sequence of returns, that if I pull money out in a down market, and my money's going to go faster than if I pull money out and had 3 or 4 years of good returns before I had a year or two of bad returns. My money's going to last longer. And I think that goes with number two, which is the 10% average. The market average is 10%. Well, historically it does, but it doesn't average 10% every year, Peter. And we can't expect it to. It's not going to. There are going to be some years, 2008, we're going to be 30, 40% off, and there are going to be other years like, 2024, where we have decent returns. So we can't afford to be complacent in retirement and not worry about our money.
The average does not equal the actual, right?
No.
The actual is very often quite different than what the average has been. And then the math behind average rates of return is a little fuzzy to rely on them for a number of reasons as well, right? Because it doesn't do that dependably. So we cannot accurately forecast our financial future basing things on averages.
Right. That's right, Peter. I mean, we have to base our numbers on actual dollars in our portfolio. If I take a loss, I have less dollars the next year, and I have to have a higher return than maybe the market's going to give me in order to make up what I lost this year. And so, I think the example that we looked at was, if I made 60% one year and then lost 50% the next, and then made 20% the next year, you would think that I would be up. But if I had 100,000, I would actually be at $96,000.
With an average 10% rate of return for your 3-year example there, up 60,
example,
down 50,
a year,
up 20.
Yep. Because I had that 50% loss, I've got less money the next year to work. So I have to make more.
Man, those are some wild swings, John. I'm not sure that I could handle that. I could handle the first year, right? The 60% return.
Yeah.
I mean, I guess that goes to another sort of myth or maybe misconception. Do you find that everybody has a higher risk tolerance when the market's moving up and sort of get complacent and just forget that the market sometimes goes down too?
Everybody wants to be fully invested in the most risky thing they can find when the market's going up. I mean, that's when we talk about Bitcoins and real estate and Denari and all this other stuff. But, when the market's going down, everybody was out. And, we can't time the market like that. We have to be in the market in order to get the dividends, but we have to have a portfolio that's based on a risk tolerance based upon where you are in life. And when I'm younger, I can have more risk. When I'm older, I need to take less risk.
And we are also told, John, that when we're older or maybe in retirement, we'll pay less in taxes or taxes will be lower in retirement. Another commonly held financial myth or misconception that does not always work out to be true, but that a lot of people base their financial strategies on. We need to carefully examine that assumption.
Well, Peter, I think when we talked about that back, 20 years ago, and when we first started really doing financial planning without the 200-page book that the computer split out for us in the early days, we were really thinking that, we would make less income, we would have less taxes, and we would live a simpler life. The problem is that taxes aren't going down, taxes are going up. Our lives aren't getting simpler, they're getting more complex, and everything costs more. If because of the reason, I told somebody the other day that because of the recent hurricanes in Florida, homeowners insurance has been going up 15-20% a year. More and more companies are leaving the state. It's going to be harder to find homeowners insurance in the future, and they're going to be more picky about what they insure. And so, that's going to create more cost. Government has to raise their taxes because we had to clean up for the storms. They had to have extra labor overtime. There was a lot of cost involved that, we're going to have to pay for. And so I don't see that we can say anymore, and we should never say that taxes are going down and I'm going to be in a lower tax bracket.
Kind of segue loosely into the next one, which is I don't need life insurance in retirement, is sort of like saying, well, if I move out of the hurricane zone, I don't need homeowners insurance, right? It's just, there's still things that can happen, and there still might be a reason why you want insurance in place. And one of the big things that catches me about life insurance in retirement, John, is, to me, that is the sense of confidence to spend my money and enjoy my retirement, knowing that I've given my spouse and my family a way to refill the bucket or recoup any costs that may be incurred along the way.
Well, life insurance has a lot of different meanings now than it used to have. When we talked about life insurance, we talked about that we're going to pay at your death. And so we're going to give your family tax-free income that are tax-free cash that you're going to be able to use in retirement, or you're going to be able to use to pay off bills, pay off the house, and you're not going to have to pay taxes on it. But now life insurance is for long-term care, terminal illness. It's a way to build up tax-free cash value by taking payments out of the policy without cashing it in. We can have tax-free income. We can have money that's set aside for long-term care and critical illness. Also, as you know, that when one spouse dies, we end up with what we call the widow's penalty, because they're going to lose one Social Security check. They're going to be in a higher tax bracket for filing taxes, and this will help keep up with that and give them some money to keep going. And the other thing, Peter, I want to say is, while we're talking about life insurance, that if you have an old policy that you don't want, there are ways now that we can sell those policies and get a cash settlement. And a lot of people don't realize that. But, there are people that want to buy your policy and keep it up because they're saying that when you die, they're going to get paid. So, if you got an old policy and you're going to give it up anyway, it's certainly a way that we should look to see if we can get some money out of it before we do.
Different options out there, ladies and gentlemen, but you do need to make sure to carefully examine your plan and your financial future. Really question the assumptions that your financial future, your confidence and stability in your lifestyle are based on. What if this happens? What if it doesn't? What if this variable occurs? Well, what if it doesn't? Are you in better or worse shape if your assumptions do not come true, right? Like the tax issue, John,
Mhm.
many saved under the assumption that taxes would be lower. Well, what if that's not the case? What if they remain the same or go higher? Now we're not in as good a shape as we thought. And I think that that is sort of the mind frame and the psychology that every financial plan should be test fired under
Mhm.
and really examined under kind of a Murphy's Law scenario, right? What can go wrong will at probably the wrong moment in time. And if it happens during the planning process and we're still in good shape, then we're probably in good shape in real life.
That's right, Peter. And that's one thing the financially focused income plan does is we look at taxes, we look at Social Security, we look at long-term care, we look at how we're going to pay the bills if one spouse dies, how we're going to live the bills, pay the bills if we have a dementia situation where we have to have confinement early in the retirement. So, I mean, there are a lot of different things that we look at that will try to give you the retirement that you want. But, you can't have a retirement that's going to be stress-free unless you know where you're going. And so, if we don't have a roadmap to get us down the road, then we're not going to be able, we don't know whether to give all the candy out today or hold some for those Halloween people that come in later. So, we've got to be able to know how much money we're going to spend, how we're going to live, and how to handle those emergencies. And I'm reading more and more about distribution. How am I going to take my assets to give me the best tax advantage, but also to give me the best long-term outcome?
Yeah, and I know that there is a premise of psychology of I don't want to lock in money for income, that I can just rely on my investment plan in
Yeah.
retirement to generate that income. And that's something that you help people work through in that financially focused written retirement income plan and see how the two sides are connected and where they are disjoined, where there is a disconnect between the investments and the income that can be generated.
Well, that's right, Peter. What we look at is how much income you're going to need. Then we try to figure out how we're going to give you some sustainable, predictable income coming in every month to have that. And then we've got a growth bucket, which is the investment bucket that we're growing to help us control inflation, higher taxes, and all the other things that are coming about so that we can then use that money to supplement the income. And we know that we've got a good retirement.
Well, if you want a team of experienced, qualified professional, John and his team there at GulfCoast Financial Services, legendary. They've been named best of the best in financial services 10 years straight and running. Give them a call to see why they continue to receive those accolades and how the financially focused written retirement income plan has helped so many identify these variables, these assumptions, these myths and misconceptions, and then carefully examine how they will work into the financial future, how to question those assumptions in each and every variable that can impact your financial future so that you can have as much confidence in your plan and your lifestyle and quality of life moving forward. That's the goal of the written financially focused retirement income plan. Give a call 386-755-9018, 386-755-9018, 386-755-9018, or visit the website GulfCoastFinancial.net, GulfCoastFinancial.net. John, lots of additional available resources there on the website. You always try to educate folks to make better, more informed decisions with their money.
Yeah, Peter, we're really excited about our website. We think there's a lot of information on it. In addition to all the past podcasts, we've also got a lot of other information that's available. And if anybody has any questions, they can always call Peter. We're more than happy to talk to them. And no sales pitch. We'll give you the answer to your question. But we love to talk to people about how they can save for retirement.
Pick up the phone, give GulfCoast Financial Services, John Kuykendall and the team a call, 386-755-9018, 386-755-9018. And be sure to carefully examine your plan and your assumptions for any commonly held myths or financial misconceptions to have as secure and confident financial future as possible. John, always appreciate the time.
Thank you, Peter. Great to be here. See you next week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions. GulfCoast Financial Services Inc. has been named as Best of the Best since 2015 in the category of Best Financial Advisor in the Lake City, Florida area. The award was based on receiving the most votes in this category from a survey offered and tabulated by the Lake City Reporter. No direct or indirect compensation was provided to the Lake City Reporter and/or any raters, and the award is not contingent on future direct or indirect compensation offered to the newspaper and/or raters. Portfolio performance is not a criterion, and voting is open to any readers of the newspaper.